What's up everybody? Nate here. Well, it happened again. Inflation just went up in the United States for the 20th straight month. In January 2022, inflation hit a new over 40-year high of around 7.5%. And that's the biggest jump that we've seen from inflation since October 2021. And with inflation now surging at an even faster rate than most experts and investors were expecting, things are about to get pretty crazy in our economy. And even though overall inflation was at around 7.5%, some things in our economy are actually even more inflated than just that. So with the brand new inflation numbers being released today, I wanted to take a minute to go over everything that is new with inflation right now and break down every single number in the new CPI report. I also want to talk about what's coming next for inflation in 2022 and beyond, and what this is all going to mean for the Federal Reserve, our economy, and the American public. But before I break all of this down, if you haven't already, do me a quick favor and hit smash or destroy that thumbs up button below and ring that notification bell too. Both of those two things are completely free and they help to show me that you really like this video and that you want to see even more just like it. Thank you so much for doing that. Now let's jump right into the inflation numbers for January 2022. So headline inflation, which measures the price of everyday goods and services that Americans are regularly consuming, went up from around 7% in December 2021 all the way to 7.5% in January 2022. That's a big increase, especially since the Dow Jones estimate was only supposed to be around 7.2%. And then of course you have core CPI, which excludes food and energy prices, and that went up to 6% in January 2022. That's also the highest it's been in over 40 years. And it's just slightly higher than the Dow Jones estimate of around 5.9%. Now the headline CPI is just kind of a basket of all goods and services in the United States, and it kind of measures the price increase or decrease on a month-by-month basis. That is exactly what the CPI or Consumer Price Index is supposed to do. But unfortunately, some things went up way higher than just 7.5%. For instance, fuel prices saw the biggest month-over-month increase out of anything else in our economy. Price of fuel actually went up by around 9.5% in January, and year over year, it's up by almost 50%. Energy costs in general are up by around 0.9%, and for the entire year from January 2021 to January 2022, they're up by almost 30%. Next up, we have vehicle prices. Now, new vehicles actually didn't increase that much in price in January 2022. However, used vehicles actually went up by around 1.5% in price. And even though the cost of a new vehicle didn't raise all that much in January 2022, over the last 12 months, new vehicle costs have gone up by around 12.2%. And the cost of a used vehicle is even higher. It's gone up by around 40.5% year over year. And finally, food costs went up by around 0.9% in January 2022, and they're up by around 7.7% year over year. And there was just one super tiny ray of light in this new CPI report. Shelter costs in the United States went up by around 0.3% in January. However, that is the smallest gain that we've seen since August 2021. Shelter costs alone take up around 1/3 of the entire Consumer Price Index. And while shelter costs are still up by around 4.4% year over year, that's below investor estimates. So with all that being said, inflation has gone up pretty significantly in every single category over the last 2 years. And as soon as this report was released, the Dow, S&P 500, and NASDAQ all dropped after having a pretty positive start to February. Like I said, this is because inflation is just getting worse in the United States. And that means there's going to be a lot of changes to our economy and monetary policy for a long time. The first thing we've seen so far is that government bonds have started to rise. They actually rose by around 2% after the CPI was released. That's the highest jump we've seen since August of 2019. But markets in general do not like inflation for a few different reasons. For one, this high of inflation means that everyday goods and services are naturally going to go up in price. And the reason they're going up in price is because of costs for employers, but also supply and demand. It's no secret that in 2022, we are still facing some pretty serious supply and demand issues that stem all the way back to the beginning of the pandemic in March of 2020. And they are not going away anytime soon. So having supply chain issues means that consumers are buying more right now, and companies can't produce enough in order to meet demand. We have such a low supply of so many things in our country right now that it's putting a lot of strain on businesses. But not only that, inflation means that businesses and companies have to start paying their employees more. But they haven't really done that yet. You see, while wages in the United States actually increased by over 4% in 2021, inflation was 7%, which means that workers actually lost around 2.4% in their wages for the entire year. And it didn't get any better in January. Wage growth went up by 0.7% according to the CPI report. But that pretty much matched the amount that inflation went up. So real wages actually only increased by 0.1%. That scares businesses because now they don't know if Americans are gonna go out and continue to spend money like they used to. Which means for Q2 and beyond in 2022, we could start seeing some terrible earnings reports. And already this year, earning reports are down for a lot of the major companies on the New York Stock Exchange. And because they hold so much market share, that means investors as a whole are losing a ton of money. Now, what exactly is coming next with inflation, and what does this big inflation issue mean for your wallet? Well, there has been a lot of speculation recently about the Federal Reserve and how they're going to tackle this inflation issue in 2022. In December 2021, they said they were going to get super aggressive with inflation by raising their benchmark interest rates and pulling a lot of their economic stimulus. There has been a ton of speculation on how much they're going to raise their benchmark interest rates and when they're going to start doing that. A lot of Fed presidents from all throughout the country have said completely different things on the issue of raising rates in 2022. Some have said they're only going to raise them 1 or 2 times and then see how the economy reacts. Others have said at least 3 raises are appropriate for this year. And then you have major businesses that have said none of that is enough. The Federal Reserve needs to raise rates 5 or even 7 times in 2022 in order to solve this inflation issue. But right now, the Federal Reserve is looking to raise its interest rates possibly in March or April of 2022. And most of Wall Street believes that it's going to be by around 25 basis points. However, after this new CPI report, 44% of investors believe that Federal Reserve is actually going to raise its benchmark interest rates by 0.5 basis points starting in March. And according to CNBC, 63% of investors believe there's going to be 6 quarter-point interest rate hikes in 2022. That would be the most aggressive that the Fed has been on inflation since the late 70s and early 1980s. But for you and your money, you can probably expect this inflation issue to not go away for the foreseeable future. You see, the reason that we're having all of this inflation right now is because of 2 main things. One is money printing. So back when the pandemic started in March of 2020, Federal Reserve and the United States federal government printed trillions of dollars from stimulus to quantitative easing on Wall Street. That created demand in general because now more Americans have more money. We didn't feel the effects of all of that inflation right away because all of that money hadn't been spent yet. So we didn't have supply chain issues either because things were slowly closing down. People weren't buying a ton yet. After all of those trillions of dollars were spent, well, now we ran into supply chain issues and money printing. Inflation can't go away because all of that money is still in the economy. It's not like it's going anywhere. People are going to continue to spend that money and it's going to continue to be circulated around. Now what the Federal Reserve is trying to do this year is lower demand. So when they printed all of that money, they wanted people to go out and spend. When they dropped their benchmark interest rates, they wanted people to go out and spend. They wanted people to go out and get a loan to buy a house or a car or just about anything that they wanted. The Fed was encouraging spending, but now they don't want people to spend any money anymore. But the Fed has to be super careful here because if they raise rates way too fast and they pull a lot of their quantitative easing measures measures from Wall Street way too quickly, well, that could crash markets and it could cause a recession. If Americans can't get loans or spend any money anymore, then they're not going to, which means businesses and banks are not going to get any money. Less money will start circulating around our economy as inflation continues to rise and Americans are only buying necessities. That's going to hurt the stock market because there's no extra liquidity flowing into those markets. It's going to hurt the housing market because now it's way harder for people to get a mortgage. Most importantly, Americans aren't going to spend, they're going to buy what they have to and then save the rest. And if the Federal Reserve gets even more aggressive with inflation, well, that might cause some situations like we saw in the 1980s where mortgage interest rates were all the way up to 17%. Right now, the average rate for a 30-year fixed mortgage is around 3 to 4%. If the Federal Reserve gets even more aggressive with inflation, well, that could mean mortgage interest rates go up to 5, 6, 7% plus in 2022, locking millions of Americans out of getting a home. Not only that though, but if all of that money that the Federal Reserve has been pouring into Wall Street suddenly disappears, well, now investors are going to be super careful with what they're investing in. The Fed has racked up a balance sheet of around $9 trillion over the last 2 years. Since December 2021, they've been lowering the amount of assets that they've been purchasing, and they want to be completely finished buying assets sometime in the spring of this year. But they are partly to blame for why the stock market has exploded over the last 2 years. They've been buying trillions of dollars in corporate bonds, mortgage-backed securities, and treasury notes. Trillions of dollars of extra liquidity for investors, and investors are going out and investing in pretty much whatever they want. That has led to some massive bubbles and risky investing on the New York Stock Exchange. But once all that money goes away, investors are going to have to decide if they want to continue that or just invest for the long term. Not only that, but it's going to hurt all of your speculative assets around the world, including a lot of your brand new tech startups and cryptocurrency. The overlap is increasing between traditional investors and strictly crypto investors. And with more and more and larger traditional investors entering the crypto market, well, they're going to treat that market like they do the stock market or other traditional markets. When things go south, they're going to pull their money. And we've started to see that in 2022 with crypto falling from its record highs. And just to be clear, the Federal Reserve has done pretty much nothing yet about inflation. They haven't raised their interest rates up from 0% yet, and they're still buying billions of dollars worth of assets on Wall Street. All of that is contributing to inflation every single day. And it means in the short term, prices are going to go up, but your asset markets are still going to be way overly inflated. In addition, there is some potential for certain assets that hedge against inflation to go up in 2022. Gold and cryptocurrency are some of the biggest and go-to investments for investors to protect their money from inflation. This is because those two assets have inherent value all throughout the world, and they're not backed by a government currency like our traditional dollars are. So ultimately, our economy is about to go crazy in 2022. They basically have to lower inflation without crashing markets and tanking our economy. All while inflation is most likely going to continue to rise as the Federal Reserve continues the money printing. They're now targeting an inflation rate of around 2.3 to 2.6% in 2022. But so far, inflation is way off that estimate. And it's now going to be up to them and the federal government to do whatever it can to lower inflation. But what do you think about the new inflation numbers? Do you think that inflation is going to continue to rise in 2022, or does the Federal Reserve have a great plan in order to lower it this year? As always, whatever your thoughts are, leave a comment below before you go. Thank you so much for watching, everyone. I hope you liked this video. If you're looking for more daily updates and breakdowns of all of the top business and financial news, our team puts together a free daily newsletter, and you can subscribe to it right now by clicking the link in this corner over here. And if video is more your thing and you want to stay up to date with everything happening in the business and financial world, 7 days a week, I've got another video for you right here. So be sure to click that too before you go. Be kind out there, everyone, and I'll see you all in the next one.